the top team from CRISIL now joining in, and they're going to run us through what they make of the impact of demonetization on fiscal 17 and look into financial year 18 as well. Mr. D.K. Joshi is Chief Economist at CRISIL. Mr. Nagarajan Narasimhan is business head at CRISIL. Pawan Agrawal is Chief Analytical Officer at CRISIL Ratings. Gentlemen, thank you very much, all of you, for being here. Let's just take it top down first. Mr. Joshi, coming to you. We just spoke with Mahesh Vyas at CMI, and he actually said something interesting. He said that according to him, demonetization has impacted the trend rate of GDP growth. So this is not just a quarter or 2 quarter kind of impact. He's talking about a trend rate being impacted. How do you see it?
Well, I think it's too early to tell whether the trend has been impacted. At this juncture, our call is that the 2 quarters growth has been shaved off. And after that, things can return to normal once the remonetization part is over and things return to normal. So it all depends on how quickly you normalize the situation. And I think there is a good possibility that the growth could pick up next year on 2 counts. One is that you have a weak base, and if the budget is supportive of growth, and interest rates already are supportive of growth. So I think we can see growth inching towards its trend rate of growth of around 8%. I think the average rate of growth in the last 13 years is 7.5%. So it's not a great achievement in that sense. But clearly from the lows we could, as far as the trend rate getting impacted is, I think you'll have to analyze much more. You have to look at the small enterprises.
Mr. Joshi, we just have to interrupt you for a second. I think we were getting some live comments with regards to the Anurag Thakur story, but we'll just get back to that in just a bit. But Mr. Joshi, please continue.
No, so what I was saying is that the trend rate of growth getting impacted, I'm not so convinced about that story, because there are things that the government has done which lift the trend over the medium run. For instance, GST, bankruptcy code, these don't push growth up quickly. They improve your trend rate of growth. So there are things which offset what demonetization has done. So it's a interplay of both these things that's going to play out over the next couple of years. And it's too early to say that the trend has been damaged as of now.
You actually are calling for a pickup, after financial year 18 onwards, April onwards, right?
Yeah, I think premised on 2 things. One, that the situation returns to normal by March. And second, you get a normal monsoons. Third,
situation returns to normal, you mean in terms of cash being in the system,
cash
demonetization?
That's right, that's right. Many of the sectors will pick up. Some sectors will see some headwinds continue for some more time. Some will recover quickly. I think that part is there. But to say that the trend has been damaged, I think it's a little early.
Okay. Mr. Narasimhan, what are your thoughts across sectors as you look at?
Taking on from what DK was saying, Prashant, I think at the broader sectoral level, there are a few themes which are emerging. Investment will probably continue to drive, and that too focused on public sector investment, which has been the story for FY17. The private sector investment, which we were expecting to start off somewhere in 18, I think will be slightly deferred. Again, the capacity utilization levels are still not up to the levels for the corporate sector to put in investments. And also there is this general sense of uncertainty. So public sector capex, that's one, which is a positive. The second positive is interest rates. I think you've seen some of the large lenders dropping their interest rates. That I think should sort of help most of the corporates, at least on given, especially the ones which are stressed on their balance sheets. But on the other side, the commodity cycle is again picking up. Crude is again moving up. Our call is that crude will probably average around about mid-50s or high 50s in the next year. So putting all of these together, our call for FY18 is that will be slightly better. FY17 first half was good, but second half is definitely going to be hugely impacted. So if you look at FY17, our overall top line growth for the entire corporates that we cover looks at around about mid to high single digits, say 6 to 8% growth, and that we expect to sort of inch up to around about 10% top line growth. On the profitability side, the second half again will be muted, and based on that, full year profitability calls is around about 10% earnings growth. That we expect expect it to sort of bump up to closer to 14 or 15%.
Which won't happen now. It stays around.
No, so this year's numbers in the first half are better, but the second half is really muted. So average, if you look at for FY17, we are looking at around about 9 to 10%. But we believe that some of the aspects that I talked about should sort of help the overall numbers to move up.
Okay. Pawan, you look at the banks and the NBFCs very closely besides ratings overall. What's your sense in terms of the lending rate cuts that we've seen? Is it enough to spur credit growth, or is there just apprehension which is possibly not going to spur credit growth, say, beyond the 8.5% that we saw in September?
Yeah, I think for the credit growth to pick up, fundamental stress on the system that we are seeing in the corporate credit side should ease. And we are not seeing that easing away in the near term. I think it will depend upon the factors on demand, which has been sustaining the credit quality so far. Because it is now weaker, at least in the near term, how soon it comes back, both on the domestic side as well as export side, I think that will be a function of that. It will also be a function of, more importantly, the investment side of the economy coming back. And at least in the near term, we see these are aspects that have been actually pushed back a little. But overall, on the credit quality side, if you look at, therefore, because some of these investments have been pushed off, what it does is it essentially improves the balance sheet strength of companies. And as a result, you are still likely to see the credit quality impact because of demand potentially being offset by the improvement that may be there on the balance sheet.
But nonetheless, we're still in conversation with the CRISIL top team. Mr. Joshi, what is your sense now in terms of further rate cuts? We've seen 175 basis points from the RBI since Jan of 2015. We're expected to see inflation to be a little subdued at least. Your sense in terms of how much more we can expect and by when?
Yeah, I think we believe that there could be another 25 basis point rate cut from RBI. Beyond that, I think it won't be possible because central bank has reiterated its stance that they are going to move towards 4%. Inflation target, and for 4%, I think the policy will have to be a little cautious. So, and which we have already seen the caution in the last policy. A lot depends on how the commodity cycle moves, what happens to crude prices, how quickly the economy recovers, because that's going to generate demand. It also depends on agriculture. I mean, whether you get a normal monsoon next year or not. So I think these three factors will shape the inflation trajectory. And if your retention is on 4%, then you can't afford more than 25 basis point rate cut.
Mr. Nagarajan, had a quick question with regards to this earnings season. What is your sense in terms of which are the sectors which might actually buck the trend and which could possibly pull down the earnings average?
The ones where, especially real estate, where there is a larger component of cash, we have seen a substantial pressure. Even within the consumption, the segments which are more luxury oriented, we have seen the pressure. However, some of the traditional ones like say metals and cement and some of the others have not done too badly. And I believe for next year also, Ekta, is that infrastructure linked, like I talked about, so construction, metals, cement, and interest rate linked, say housing, the auto segment will do relatively better. Even the consumption, say consumer durables and FMCG. The ones which are under stress are the ones which are heavily indebted, like Pawan was talking about, so the real estate sector. Some of the other sectors like say telecom, IT and pharma could face other types of challenges. So you are seeing a lot of pressure globally for IT, pharma, again a lot of regulatory changes. The big opportunity from new drug launches and all, that is going to be relatively muted. Telecom is going to see a lot of pressure from competition and investment. So those are sectors which we believe will be slightly muted next year.
Mr. Agrawal, for financials, do you think incrementally things are getting better or they're getting worse? I mean, lenders of all hues, be it banks and BFCs, etc.
If you look at, again, the outlook for corporate lenders, I think still remains cautious. Asset quality challenges we will still see continuing for at least the next 12 months, more importantly in the next at least couple of quarters. they are likely to be eased a little because of the interest rate transmissions if they actually get a little embedded, because it will improve the viability of some of the underlying projects. But if you look at on the retail side, outlook is a shade better, although in the near term you will see some challenges on collection efficiencies or collection ratios.
I mean, so incrementally things have only gotten worse there, right? I mean, because they were looking up before this
From a
announcement.
demand perspective, yes, but not necessarily from a profitability perspective.
Okay.
I think again the transmission of interest rates that has happened through the bond markets already, and now that you are seeing from the bank loans, what it will do is that it will reduce their cost of borrowing, but the lending rates have not necessarily come off to that extent. So that will provide some cushion to absorb some asset quality challenges. And structurally, if we look at, we just believe that over the next 2 to 3 years, NBFCs should improve their share of credit in the market share by almost 200 to 300 basis points, because structurally they are better placed in terms of reach, the product designs, etc.
Do you expect them to come back to the valuations that we saw pre-demonetization? A lot of them were at 2 to 3 times book, and there's been a significant correction. So, for example, Bharat Financial is at 2.4 times versus 3.8 times when it was at its 52-week high.
I would say that it will, at least in the near term, be difficult, given the fact that you will see the impact of lower disbursements playing out over the next couple of quarters. Over a longer term, I think the demand perhaps will actually be favoring them, because we believe that shift from unorganized lending to organized lending will create more opportunities for non-banking finance companies.
For the formal sector.
For the formal sector, yes.
Mr. Agrawal, Mr. Narasimhan, Dr. Joshi, thank you all for dropping by. Appreciate your time as always. Thank you.